Hey everyone, welcome back to the channel. If you're nearing retirement or just planning for your future, then you've got to hear this. Today we're talking about a financial risk that could make your retirement plans go poof, sequence of return risk. And no, it's not a new reality TV show, though it sounds like one, doesn't it? But trust me, it's something much worse than a bad plot twist. So if you're ready to learn how to protect yourself from this sneaky risk that could mess with your retirement savings, keep watching. Before we dive in, don't forget to hit that like button, subscribe if you haven't already, and share this video with someone who needs to know these strategies, because let's face it, nobody wants to retire and watch their nest egg take a nosedive. So first things first, let's get on the same page. What exactly is sequence of return risk? No, it's not some kind of alphabet soup you need to decode. It's actually pretty straightforward. Picture this. You've been saving your whole life. You've worked hard, and now you're ready to kick back and enjoy those retirement years. But bam! The market decides to take a dive in the first few years of your retirement. Suddenly you're pulling money out of your accounts while the market is down, and you're locking in those losses. Ouch! That, my friends, is sequence of return risk in action. In simpler terms, it's the risk of bad returns early in retirement which can drastically affect how long your money lasts. The worst part? It's all about the timing. So even if your portfolio does well overall, a bad sequence of returns in the first few years could wipe out your long-term plans. It's like planning a road trip. But instead of smooth highways, you hit every pothole along the way. Yikes! So why is this such a big deal? Well, the timing of your returns in retirement matters a lot more than when you are working and contributing to your portfolio. Here's why. In the early years of retirement, you're selling investments to live on. If you're withdrawing from your portfolio during a market downturn, you may have to sell off more shares to make up for it. That means locking in those losses, and that can hurt for years. It's kind of like planting a garden. If you plant your seeds during a drought, they won't grow, no matter how good the soil is. But if you plant them when the weather's great, those flowers will thrive. The key here is that you don't want to be withdrawing when your investments aren't growing, because that's how your garden, aka your retirement fund, goes from flourishing to, well, bare. Okay, now that we know what sequence of return risk is and why it's dangerous, let's jump into 5 ways you can protect your retirement savings from this risk. These strategies are super practical, so grab a pen and let's get started. Strategy #1, the bucket strategy. This is one of the most popular ways to protect against sequence of return risk. The basic idea is to create 3 different buckets for your retirement funds, each with a different purpose. This bucket holds your immediate needs, usually 5 years of living expenses. It's filled with cash or very low-risk investments, stuff that won't fluctuate much. The idea is that during the first few years of retirement, you live off this bucket and don't need to sell anything that's down in the market. This bucket is your mid-term money, holding investments like bonds or balanced funds that grow steadily but are a little safer than stocks. This is for the next 5-10 years of retirement. And here's your growth bucket. Think stocks and equity-based investments. This bucket is for long-term growth and will be used after the first 10 years of retirement, once your other buckets have been used up. Think of it like having a safety net to keep you from panicking when the stock market does its thing. You get to avoid selling in a down market because you're drawing from your cash and bond buckets instead. Strategy #2, lower your withdrawal rate. It's tempting to start living the good life in retirement, but taking out too much money too quickly is a major culprit in destroying your portfolio. The typical rule of thumb is to start with a 4% withdrawal rate. This means you withdraw 4% of your total portfolio each year. If you withdraw too much, you risk running out of money in the later years of retirement. Instead, start smaller if you can, maybe even 3% or less depending on your situation. Think of it like having dessert. You don't want to eat the whole cake at once. A little slice goes a long way. Strategy #3, diversification. Now, I know you've heard this one before, but I can't stress enough how important it is to spread your money across different types of investments. Stocks, bonds, real estate, international assets, even some cash. The more varied your investments, the better you'll be able to handle volatility in the market. Imagine trying to run a race with just one leg. Pretty tough, right? Well, diversification is like having both legs under you. It gives you more stability and flexibility to adjust if something goes wrong. Strategy #4. Delay Social Security benefits. If you're in a position to do so, consider delaying taking your Social Security until after your full retirement age, or even as long as age 70. This gives your funds more time to grow and provides you with a higher monthly benefit when you do start withdrawing. Not only does this give you more financial cushion, but you'll also be setting yourself up with bigger monthly checks in the future. It's like the retirement equivalent of getting a raise every year. Strategy #5. Consider annuities. I know. Annuities aren't always everyone's favourite topic, but they can be a good way to guarantee steady income in retirement. With a fixed annuity, for example, you get a predictable income stream for a set period or for life, which can help shield you from sequence of return risk. It's kind of like having a steady paycheck that you can count on every month. Sure, it's not as exciting as hitting a home run in the stock market, but it sure feels good when you know your bills are paid. So, there you have it. 5 ways to protect against sequence of return risk. These strategies are simple, effective, and will help you sleep better at night knowing you're prepared for the ups and downs of retirement. If you found this video helpful, please do me a huge favor. Hit that like button, subscribe to the channel, and share this video with anyone you know who's getting ready to retire or is already in retirement. The more people who know about these strategies, the better. Thanks for watching, and we'll see you in the next video, where we'll dive into more ways to protect your financial future. Take care and happy planning.